Good evening. This is Ken Long from Tortoise Capital Management. It's July 30th, 2009. This is case study number 3 of 4 from our intraday trades from our chat room, which were set up by last night's daily market preparation. This trade is a Max Payne trade in Alcoa, symbol AA. It's one of my favorite trading vehicles. It has a lot of intraday volatility. It moves in powerful swings. It's related to commodities. It's a large cap stock that's in the Dow 30. My sister-in-law, who's brilliant, works there, and it's a great company. So I always pay attention to this one. In last night's trading plan preparation, we looked at Alcoa and Cleveland Cliffs as potential reversals for today based on the fact that they were leading contenders for the Max Payne Award. And that means that they have lost more on a percentage basis since the 10-day high than other members of the Dow 30. So we're prepared for a reversal in price, knowing that the first day and the first moves are the most powerful ones. We're prepared to take advantage of that. So we see where Alcoa closed yesterday, just right around $11 even. Gaps up to about 11 and a quarter. Goes up, then comes back for 3 red candles. Just like the rest of the market, you've seen that in the previous 2 trades, so that was sort of the pattern for the day. We get a green candle. We buy a penny above the first green candle. We establish our 10-cent trailing stop in Alcoa. And because we're buying on momentum, that first burst of momentum in the first 5 minutes takes us up to the point where we can move our stop from the red line to the green line. And once again, in less than 10 minutes of open risk, we're at a no-lose position, and we can afford to let the trade unwind. The trade goes up to about 1140, pulls back in an orderly manner, and then resumes its march northward. At each of these yellow dots, there was a potential for adding to this position. I had already spent all my bullets for the day, however, on other positions, and so I didn't have any discretionary money left, and I hadn't taken any profits yet from the first trades of the day, so I have to simply observe those 2 opportunities. However, that's a pattern that we typically look for. You'll notice that's sort of the same price action that we use to get into the initial position, and that is evidence of strength, minimum 3 red candles coming back, a green candle, and then buying a penny above that first green candle. And so there was a potential here and a potential here. The position moves to $11.50, a nice round number. We had targeted $11.50 as a previous swing high and a resistance level. The entire broad market was beginning to stall at about this point, and this is the same position we were in the other 2 trades we've already looked at. Our reward to risk ratio, based on the entry, the initial stop, and the profit target, was 2 to 1. On this one, I risked 1 small bullet, so $100 with a 10-cent trailing stop is 1,000 shares. 5 minutes of open risk. An hour later, we're at 11.49, holding almost 2R, or almost $200 on the initial trade, and this is where I cashed. And once again, I hope to put you in a position where you can suffer with what to do with these initial gains. So that's the Max Payne strategy. It's a setup that looks for those large cap stocks and ETFs that have lost the most on a percentage basis since their recent 10-day high. And then we rank order by Max Payne having lost the most, and we look for evidence of reversion to the mean on these. It worked out pretty nicely right here in Alcoa. Thanks for your attention.